Good morning. So with regard to marine insurance, I never intended to work on this topic. My work on commerce rating, that is on piracy, on anti-piracy and anti-privateering, the suppression of piracy and privateering, led me to examine marine insurance rates as a way to gauge the scope of those trades. Okay, how many cargoes were lost to commerce rating? And actually, to report on, excuse me, the point was to report on how insurance underwriters in the 18th and 19th centuries gauged the scope of piracy and privateering. And that's what I'll discuss today. Underwriters' attempts to reduce the number of claims by curbing commerce rating, as well as other hazards of the sea. I will begin with an overview of the expansion of the marine insurance market in the 18th century and how the practice of insuring cargoes insulated merchants and investors from much of the damage caused by commerce ratings. Okay? So merchants, broadly considered, were not enemies of commerce rating. Okay? Freebooting or commerce rating was a profitable enterprise which financiers, merchants, sailors, and laborers were eager to exploit, to be a part of. Marine insurance allowed them to yield profits from maritime predation and other advantages of wartime trade, while protecting or insulating themselves against losses due to attacks at sea. So I'll discuss that, and I will then discuss how this risk shifting put pressure on insurers to develop expertise not only in underwriting, but also in shipping and navigation and naval and maritime policy. The efforts to suppress commerce rating was part of a much larger project undertaken by underwriter associations to reduce a variety of shipping risks. That is, from their perspective, to reduce the number of insurance claims. Now, many of these endeavors involved lobbying national governments to take action at sea, but they also involved private and governmental public relations efforts aimed at merchants, ship owners, and mariners. And this will be my final point. The insurance sector aimed to harmonize or to synchronize the interests and the habits of the merchant class and of national governments. Okay, they meant to make them one and the same. Since underwriters were the primary victims of shipping risks, it was the marine insurance sector, rather than the merchant class as a whole, that took the lead in trying to mitigate various risks at sea. So, as late as the late 17th century, most commercial shipping went uninsured. Merchants protected their investments by either arming their ships to thwart attacks, or by or reducing risk by buying small shares in a number of ships and cargoes, or maybe doing the opposite, dividing a cargo into small consignments on different ships, or entering into agreements with other merchants to share in one another's losses at sea. Okay, so the idea was to share the risk or mitigate the risk. So either protecting oneself against attacks, or all sorts of financial arrangements to mitigate the losses or share the losses. As long-distance trade expanded and the habit of purchasing insurance for commercial vessels began to take hold, the insurance market expanded, leading to a steady decline in rates. a roughly 50% drop between 1650 and 1750. Okay. This consistent price cutting was a result of greater competition among underwriters. This was like I said, it was a profitable market, a profitable enterprise, a profitable market. More underwriters wanted to get in, and so as part of this competition, prices dropped. The price drop certainly did not coincide with and did not reflect greater peace or security at sea. This rate reduction cut underwriter profit margins, but on the other hand, the cheap cost of insurance allowed English and European merchants to insure ships and cargoes as a matter of course. Each insurance contract yielded smaller profit, but there were many, many more insurance contracts. Okay? Many more contracts were sold. Okay? So it's kind of like when you compare Macy's to Walmart. Okay? Smaller profit margin, but the volume of sales is much higher. So the market therefore expanded further because the prices were so low. More people bought insurance, more merchants and ship owners, which led to increased competition and even lower rates, especially with the emergence of an American marine insurance industry in the 1720s and 30s. Now, as I mentioned earlier, merchants were not enemies of commerce rating, freebooting, etc. Analysis of Dutch and British maritime trade indicates that piracy and privateering did not cut that deeply into merchant profits. Even with the higher cost of freight and insurance in times of war, and with losses from hijacked cargoes in wartime, the data suggests that the profit in wartime was greater, even though less predictable, than in peacetime. So it's quite likely that the harmful effects of war and commerce rating on overall trade are overstated. And losses suffered by merchants were certainly mitigated by marine insurance and offset by benefits presented by a wartime economy. Government contracts, financing opportunities, rising retail prices, and profitable commerce rating on their own. You know, they were also involved in commerce rating, which yielded good profit. So merchants, financiers, and ship owners had various opportunities to recoup losses incurred due to piracy and privateering, but they also sought to protect themselves from such risks with marine insurance and protective convoys. Now, protective convoys were a tricky proposition because they were effective in reducing the risk of losses at sea, but we know that they did not engender much enthusiasm on the part of most merchants. Okay? And that is because ships often remained at port waiting for a convoy to materialize and for naval escorts to arrive. And in the meantime, as they were waiting, merchantmen's costs for provisioning and provisions and wages kept mounting at port, while profits from beating other vessels to market diminished. Add to that the fact that perishable cargoes were yet another disincentive for convoying, because as you had to wait, there was more spoilage. Not to mention, you know, on top of that, another disincentive were the various fees that were sometimes charged by the Admiralty for the service of escorting a merchant convoy. So it's evident that convoys worked more smoothly in trades that were monopolized. The large sums paid in import duties by commercial giants like the Dutch and English East India companies, or the Levant Company, gave national governments a strong incentive to protect the ships of those large trading firms. But in trades that were more competitive and less centralized, especially in wartime economies that featured these sharp spikes in demand, profits depended on arriving to market first when demand was high, in order to beat all the convoyed vessels that arrived at port instantaneously, thus flooding local markets and lowering retail prices. So merchants regularly chose to risk the loss of their cargoes to privateers rather than take advantage of naval escorts and the low premiums that were offered by insurance underwriters for convoyed shipping. And this substantiates claims regarding the profitability of trade despite the high levels of maritime predation. And we can see merchants at the time who had a better understanding of their risk and reward. They chose to avoid convoys and to set out unprotected into the Atlantic or the English Channel, etc. Okay, so it indicates that we might be imagining the losses, especially in the age of insurance, as losses due to commerce trading as greater than they were, or at least we're not offsetting them enough by the rewards. Okay, so while losses to pirates and privateers were merely possible, convoying represented losses that were certain and predictable. So marine insurance was therefore the more effective and more common measure adopted by merchants to insulate themselves from freebooters as well as from other perils of the sea, storms, etc., navigation errors, spoilage. However, the widespread practice of insurance created its own independent set of incentives. So underwriters understood that merchants, ship owners, and captains were routinely reckless, breaking convoy when they neared destination ports or traveling without convoy altogether, precisely because they insured up to 99% of the value of their ships. Therefore, insurance insulated merchants from the financial damage or financial toll of commerce raiding and eliminated incentives to avoid dangerous waters, sail in convoy, or invest in other defensive measures. For example, you could increase the number of guns and crew members at the expense of cargoes. But if you're insured, why do that? So the habit of insuring ships actually increased the prevalence of seizures at sea. Now, since insurance providers had assumed virtually all the risk of shipping cargoes across the Atlantic, the insurance underwriters took the risk or assumed the risk from the merchants. Okay? So the insurers who covered the cargo took on the risk of shipping from the merchants who owned the cargoes. Therefore, these underwriters came to bear the brunt of losses at sea. And just as risks at sea drove merchants to a wholesale adoption of marine insurance, of insuring their cargoes, these same risks similarly drew insurers or impelled insurance to inventive techniques of their own to motivate crews, captains, merchants, ship owners, and governments to reduce the incidence of insurance claims. So insurers in both the Netherlands and in Britain used a variety of counter incentives to motivate owners, masters, and crews to exert their own efforts to reduce losses at sea. So underwriters offered lower premiums for cargoes traveling under convoy, or they would refund a portion of the premium to an owner whose ship arrived safely at its destination without being attacked, without having been attacked. Okay, so basically, if you didn't file an insurance claim, you got some of your money back. Okay, and that would incentivize you to either convoy or take protective measures or evasive measures. Also, insurance underwriters bestowed honors, awards, and financial rewards on captains and crews who evaded freebooters or defended their ships when attacked. And these tributes were offered even when the crews were eventually unsuccessful in preventing the capture of their ships. These countermeasures, these counter incentives, were deemed necessary because merchants often, the merchants, the ship owners, often offered ship captains financial incentives to break convoy in order to arrive at market first when the prices were high. And there are numerous complaints in the records by naval officers and admiralty officials repeatedly complaining about this, that, hey, we're providing convoy, but the ships that we're protecting are breaking convoy and getting attacked. I mean, some of them are getting attacked. Okay, so they're explaining it's not our fault, not that we have failed to protect them, they are breaking convoy. Now, in rare cases, underwriters even resorted to taking matters into their own hands. For example, there's a record of a group of insurers filing a lawsuit against a rogue privateer, or even outfitting a vessel to hunt down a pirate that was attacking British shipping in, I can't remember if it was in American waters or in the English Channel. In any case, the underwriters got together, pooled their money to outfit a privateer to hunt down this pirate. And you can see again how the risks of shipping had shifted from the ship owners and the merchants to the insurance underwriters. But the primary effort underwriters and insurance firms took to minimize their losses was lobbying power brokers in royal courts and national legislatures to both fund and mandate convoy protection. So to force merchants by law to travel under convoy and to fund these to make these convoys cost-free for the merchants. Okay, and forcing them on the one hand and incentivizing them on the other. So that was one lobbying effort on the part of insurance underwriters to the government. But they also lobbied governments to encourage it to enact or to conduct stronger naval actions against pirates, privateers, and coastal wreckers. To be firmer and more muscular in their actions at sea, at port, and in coastal waters against pirates, privateers, and wreckers. The increasing severity of punishments stipulated by law for such offenses in the 18th century, in the late 17th, and throughout the 18th century, indicate that these lobbying efforts on the part of insurance underwriters were successful in producing legislation, even if this legislation was not particularly successful at eradicating these trades and changing the habit of ship captains, merchants, mariners, and constituents, resident in coastal towns, who regularly traded with commerce raiders and pirates, wreckers, and privateers. In 1780, and again at the outbreak of the wars of the French Revolution, the lobbying efforts emanating from Lloyd's of London and the London Assurance Company led to legislation requiring all British vessels conducting foreign trade to sail in convoy protected by British ships of war. And to this end, underwriters at Lloyd and at the London Assurance Company provided Parliament with statistics relating the undeniable effectiveness of convoys in protecting merchantmen and reducing, of course, the number of insurance claims arriving at Lloyd's and the London Assurance. Now, under the late Stuarts, at the turn of the 18th century, England saw the emergence of an energized, innovative, and increasingly large lobbying enterprise, or I guess enterprises. Policy-related lobbying became more common as it became more effective in the 18th and 19th centuries. Since the central government appeared to be more attentive and responsive to public pressure, it paid to invest more in lobbying. It was simply effective because public opinion was becoming a more and more significant force in public life and governance. Because marine insurance required large amounts of liquid capital, underwriters were well positioned and equipped to bring influence to bear on government officials. The London Assurance Company was particularly influential politically because it offered the ministry much needed loans to cover its wartime operating costs. A notable example of successful lobbying on the part of the marine insurance industry was the Marine Insurance Act of 1745. In the early stages of the growth of the marine insurance industry in both the Netherlands and in England, interest groups within the industry had sought the passage of laws compelling all merchants engaged in overseas trade to purchase insurance. It was energetically resisted and defeated by merchants. But this episode nevertheless highlights the divergent interests of insurers and merchants with regard to maritime trade. And this divergence was evident also in the two groups' attitude towards commerce rating. While merchants and others continued to enthusiastically draw profits from commerce rating and its attendant trades, smuggling and contraband trade, etc., insurers lobbied governments to act against freebooters, to initiate pursuits at sea, preemptive patrol along trade routes and coastlines, offering or even mandating protective convoys, energetic prosecution and for those captured, and harsh punishment, usually capital punishment. And this had become a more pressing need for insurance from the early 18th century on, as growing competition in the insurance market led to consistently reduced rates, thus cutting further into underwriter profits. So insurance underwriters hoped to reverse this trend and improve profit margins by reducing the incidence of attacks at sea. And particularly appealing in this respect was the fact that the efforts to curb maritime predation and reduce underwriter losses would be taken at the government's expense. Hence, again, especially with regard to convoying and pursuing, capturing, and prosecuting pirates and privateers. These are all government actions funded by the Treasury. So by the early 19th century, insurance underwriters were accustomed to pressing Parliament for action against freebooting, and Lloyd's reports on piracies were routinely passed on to the Admiralty as raw data. And the same dynamic can be observed in the United States. An examination of petitions from the business community regarding federal actions against commerce raiders reveals that they originated, in fact, not from the business community writ large, but specifically from the insurance community. The establishment of the New York Board, which was a body that represented the city's marine insurance underwriters and was dedicated to regulating premiums and standardizing underwriter procedures, the establishment of the New York Board was truly consequential in this regard of, again, synchronizing the interests of and the actions of the insurance market or insurance providers and the government. First, it led to the New York Board led to the formation of similar collective associations in other large port cities, such as Boston and Philadelphia. And these boards then used their resources and their clout in the early and mid 19th century to further the interests of underwriters, and specifically to reduce underwriter losses. To combat losses due to fraudulent claims and criminal wrecking, they pressed for the appointment of sympathetic federal judges and prosecutors. They sponsored and subsidized a coastal telegraph line, which helped, by the way, to launch the American Telegraph Company, which eventually became AT&T. And they sponsored coastal life-saving stations, which were also responsible for protecting shipwrecked cargoes and crews from wreckers and looters. And these boards actively lobbied state and federal legislatures for regulations to improve piloting standards. They helped finance improvements in piloting training and services. They petitioned and otherwise pressured the authorities for navigation aids, such as coastal lighting or lighting ships. They helped finance the Federal Revenue Cutter Service. They petitioned the Congress to fund and conduct updated surveys of dangerous coastal waters. They printed and distributed updated navigation charts and promoted the adoption of rules of the road to help captains avoid collision. And they also, of course, lobbied for naval protection for merchant shipping against commerce raiding. Like Dutch and English insurers in the previous 2 centuries, American insurance providers understood that underwriter profits were shrinking due to competition and lower premiums on the one hand, and due to continued losses at sea on the other. And like their European counterparts, American boards focused on measures designed to reduce the latter, to reduce losses at sea. And such efforts reflected a recognition that marine insurance relieved merchants and captains of the responsibility and expense of defending their own cargoes. And again, since insurers now bore the cost of losses at sea, it's they who attempted to limit these kinds of losses, to limit their liability by having these cargoes protected by naval patrols and naval convoys. Now, in Britain, underwriters or underwriter associations continue to use their influence to obtain from the Admiralty protective convoys for British shipping and to urge the Admiralty and the Foreign Office and the courts to respond vigorously to piratical depredations. Okay, so basically, we see the American insurance market as it developed later than the British and Dutch one, basically suffering the same consequences, which are built into insurance underwriting, and responding in the same way primarily by lobbying governments. Underwriters also took the lead in orchestrating well-publicized charitable collections on behalf of British naval officers, sailors, and their families, which contributed to a more amicable and cooperative relationship between the Admiralty and commercial interest groups. The Admiralty's commitment to protect British shipping received positive press coverage in commercial centers such as London, Bristol, and Hull. And these port towns repeatedly voted to fund the recruitment of seamen for the Navy by offering bounties for volunteers and setting up schools to train vagrant boys for service in the Royal Navy. So these patriotic measures alleviated the Navy's, or addressed the Navy's manpower needs, and thus enabled merchants to both protect their own shipping crews against impressment, against the draft, and to curb the upsurge in sailors' wages, especially in times of war. Such fundraising drives, as well as sponsorship for monuments and memorials and conspicuous contributions to naval charities, also allowed merchants to establish genteel credentials as benefactors of the Navy. The cooperative relationship promoted and sponsored by the insurance industry between the Admiralty and commercial interest groups was certainly economically and politically beneficial for the financial and mercantile sectors, as they grew increasingly dependent on long-distance trade during the course of the 18th century. Moreover, these informal ties could lead to lucrative contracts with the Navy or other departments of state. Okay, so it really was a forum for addressing everyone's needs, the Navy's, the insurance market, and the mercantile sector. However, royal administrators supported commerce protection not only because of organized lobbying from the marine insurance industry and the large trading firms, but also out of genuine concern for the economy's health, not to mention institutional self-interest. Secure trade generated tax revenues for the Treasury in the form of customs duties. And the growing effectiveness and regularity of British tax collection, including customs duties, enabled the Treasury to borrow at lower interest rates. So the Treasury therefore gained by investing in commerce protection, and the merchant elite gained by paying customs duties and funding the national debt. And this explains the growing willingness of this commercial and financial elite to acquiesce in time later to increased rates of taxation. Thus, in 1798, when Parliament imposed a convoy tax in the form of a tonnage duty, it elicited neither criticism nor non-compliance from the large trading firms and the established merchant families. This merchant elite was indeed praised in government-sponsored publications for its patriotic willingness to shoulder the nation's tax burden. Now, since insurance underwriters, more than merchants and ship owners, were the ones absorbing the costs or the losses relating to maritime predation, they actively lobbied governments for anti-piracy activism at sea and in court, and for a naval policy of commercial protection. They also offered merchants and crews various incentives to avail themselves of convoy protection or to otherwise protect their cargoes. And finally, as I just explained, they underwrote other initiatives, both privately and in cooperation with the Coast Guard, to improve and secure maritime navigation. A policy of commerce protection, coupled with patriotic public relations efforts by the Admiralty, the merchant elite, and the marine insurance industry, strengthened financial and social ties between the merchant and manufacturing community, the Admiralty, and the Treasury. And this two-pronged approach served in time to generate a sense of partnership and a confluence of interests and ideology between merchants, the state, and insurance underwriters. Thank you.